Welcome to Essential Dialogues. Today we're going to be taking a deep dive into Ethiopia's credit conundrum.
Ah,
Ethiopia's central bank, you see, they're adjusting their approach to credit growth, moving away from a strict cap and sort of moving towards a more nuanced price-based system. With me to break down this topic, I've got an expert. So let's dig in, shall we? First, what exactly are these recent decisions from Ethiopia's Monetary Policy Committee that we're talking about today?
sure. So, about 2 years ago, the National Bank of Ethiopia imposed a 14% annual credit growth limit on banks, now based on the recommendation of the newly formed Monetary Policy Committee. This limit has been revised to 18%.
Okay, so they bumped it up a bit. But why? What's the rationale behind this revision?
Well, a few factors influence this decision.
Makes sense.
The first is liquidity. The banking system is currently experiencing some unusual liquidity constraints.
So basically the banks are kind of
Yeah.
strapped for cash.
Yeah,
Yeah.
you could say that.
Okay, and what else going on?
Well, the second factor is monetary tightening. The economy is undergoing significant monetary tightening relative to overall GDP growth.
Okay, so the government's trying to control inflation,
Exactly.
and that brings us to the third factor.
Right. The third factor is a broader shift towards a price-based monetary policy framework.
Can you unpack that for me? Lawrence?
Sure. Essentially, it means they're moving towards letting market mechanisms like interest rates play a bigger role in managing the economy.
Got it. So it's less about hard limits
Uh,
and more about influencing behavior through pricing.
Exactly.
Okay, so how is all of this actually playing out?
Well, despite a 19% increase in total domestic credit, the growth rates of broad money supply, M2, base money, and total domestic credit have actually fallen below nominal GDP growth.
So the government's efforts to control inflation, they're having some effect.
Yes, it seems so.
And speaking of inflation, what's the latest on that front?
Well, annual inflation is decreasing. It recently reached a 5-year low of 16.9%.
That's
Yeah.
pretty good news, right?
Yeah.
Yes. It's a positive development.
But I imagine there's still some challenges.
Yes, of course. While food inflation stands at 18.5%, non-food inflation has climbed to 14.4%.
So some areas need more attention than others.
That's right.
Okay, so let's broaden our perspective a bit. What are some of the global economic factors that might be impacting Ethiopia right now?
Well, globally, oil prices have dropped by 15%.
Okay, and how does that affect Ethiopia?
Well, lower oil prices generally provide some relief for oil importing countries.
Makes sense. What about Ethiopia's exports?
Well, the international prices
Right.
for Ethiopia's major exports, things like gold, coffee, other commodities, those have actually increased.
So that's good for Ethiopia, right?
Yes, it indicates promising prospects
Yeah.
for foreign exchange earnings.
Okay, so we've covered a lot of ground here. But what's the big takeaway? What does all of this mean for Ethiopia's economic future?
Well, the Ethiopian economy is at a crossroads.
Okay.
This shift away from strict credit caps, it signals a new era of monetary policy.
With potential implications for inflation, investment, and growth.
So it's a bit of a gamble then.
You could say that.
On the one hand, it could lead to greater financial stability and prosperity.
Yes,
But on the other hand, new challenges could emerge.
precisely.
So it'll be interesting to see how this all plays out.
Definitely.
Thanks for joining me today.
It was my pleasure.
And thank you for tuning in to Essential Dialogues. Don't forget to like, share, and subscribe for more deep dives into critical global issues. Until next time.